Good morning. Thank you for joining us. Welcome to Fundamentals with Matt Burk. I am your host, Matt Burk, and Fundamentals is a LinkedIn live show focused on all things around real estate, private equity funds for real estate asset-based strategies of all types. Really try to focus on the challenges that new fund managers have setting up, launching, running real estate funds, and to have guests on that can speak intelligently about that. And I'd say Jay falls squarely in that category. Jay is a colleague of mine. Jay and I have known each other, Jay, going on 15 plus years, I think.
Plus, yeah.
By now. And Jay is Fairways and Verivest's general counsel. Jay plays a very active role in our advisory work that we do with fund managers, and has an extensive amount of experience and background in funds. So please, Jay Zollinger, welcome to the show.
Thank you, Matt.
Glad to have you on. So I think we'll have a little wide-ranging discussion today, maybe focus a little more on, we don't often do this, but on the legal side of things. And I know Jay is, even though Jay is a lawyer, Jay does not represent anybody who is listening on this call, correct, Jay? So I don't know if you want to give your standard disclaimer before we
Other
get started.
than you, Matt. That's right. So yeah, we'll talk about a lot of legal subjects today, but I can't represent anybody who's listening other than Matt and Fairway and Verivest, and would strongly encourage anybody to consult with their own independent counsel before taking any actions based on anything you might hear today. I should also say I may very well get some of this wrong, depending on what we cover. So don't rely on it.
Yeah. So maybe let's start there, Jay, is on the legal front. We've long talked about, a big part of our value proposition is coming at the whole process from a manager's perspective, right? And lawyers are absolutely essential in the process with respect to making sure that clients have, are compliant with securities law. Securities law is a very complex part of the law, and there's a lot of rules and regulations and do's and don'ts, and many of them are conflicting, and many of them are state by state. And so there's just a lot of stuff there that you need to pay attention to. But there's also a lot of stuff that the lawyer doesn't really have a whole lot of experience in on the business side, or how they all tie together. So having done this for as long as you have now, Jay, what's your observation with respect to where the lawyer really adds value, and where maybe they're not as compelling or as appropriate a solution to someone who wants to set up a fund relying strictly on a lawyer?
Yeah, that's a really good question. I feel a lot of times like we're dancing in a minefield. As soon as you identify one mine and make a move to avoid that mine, you're face to face with another one. And there's such a complex interplay of different regulations that impact fund managers, from securities law, to contract law, the real estate work that you need to do. But even within securities law itself, you've got the Securities Act, you've got investment company acts, you've got potential securities fraud to your investors. And you should all be working with a really good securities attorney, somebody who you really like and know and trust and sync well with, think the same way as they do. And they can help guide you through all of those nuanced legal issues to understand, where your risks are, how to mitigate them, and, how to move forward in that minefield. Where they're probably not as good is on the business side of things. They understand what they need to do to set up a fund that's compliant with the Investment Company Act and the Securities Act and those kinds of things. But they don't really know how to run a fund. They've never done it before. They've never really brought in money from investors. And obviously I'm generalizing, and some of you may be really lucky to find an attorney who's also has the practical business experience. But, Matt, you talk about earning your PhD in fund management over the years. And I think over the 15 or so years that I've been here, I'm continually astounded at how much we learn about running funds as we run them, and I expect that to continue into the future. And that knowledge base that you get from actually doing it is something that most attorneys just can't provide. So I would say, love your attorney. If you don't love your attorney now, think about finding a new one, but find somebody who you can work with to understand the legal issues, but don't rely solely on them to tell you how to run a fund, because they don't know that aspect of it.
Yeah, one of the biggest questions that I get all the time that maybe you can speak to, Jay, is the idea of like, do I have to be licensed? Do I need to be a registered investment advisor? All of that. And there's, this whole issuer exemption thing that managers can rely upon generally. And again, this isn't legal advice, but just generally high level, what's your understanding of if a manager's starting a fund for the first time and running it, do they need to become a registered investment advisor?
Yeah, it's a really good question, and one that's really hard to answer in the abstract, right? Under the federal set of regulations, if you're only making one offering, you can probably qualify for the issuer exemption, and you would not need to register as an investment advisor. But if you're in California, Washington, a few other states, those states are pushing really hard to have everybody register, and it may not be possible to avoid registering as an investment advisor. Um, and
And
that's
at a state level, depending on what state you're in, right?
Yeah, at the state level, which is where any new fund manager starting out would have to register. You can't actually register with the SEC until you have, I haven't looked at it in a while, but at the time it was 150,000 in assets under management, when you jump from state regulation to SEC regulation. So generally, somebody coming out would have to register with the state agency if they need. And there are some states where your state will probably tell you that you need to, and other states where you probably don't need to. Um, that's another question, though, that you can ask several different attorneys, and you may get different answers. Some attorneys will tell you everybody needs to register out of the gate. Others read the rules a little bit differently, and will give you a different answer on that.
Why is it that you can get different answers from different, attorneys when, presumably the laws are what they are? Like, how is it possible that happens?
That's a good question. Depending on the attorney that you're talking to, they may or may not be familiar with the laws of the state that you're in. They may or may not really even be familiar with the specific laws that you're talking to them about. The laws also, assuming your lawyer is familiar with the laws are nuanced and somewhat difficult to understand sometimes. What does it mean to actually have an offering? Because that's one of the primary ways that you would avoid registration would be under the issuer exemption. But understanding when you've crossed the threshold of doing too many offerings in some period of time can be somewhat nuanced and tricky, which again is why I encourage everybody to talk to competent counsel. Make sure they really understand the facts of what you're doing, and really dig in with them before you take any action on that kind of issue.
So when people are setting up funds, I mean, I know there's a variety of ways of doing it, and we've long, favored Regulation D funds, right? But there are other types of offerings, and I know you've been doing some homework lately on this topic. But again, at a super high level, because obviously there's tons of nuances and sort of beyond the scope of this discussion, but just high level for people's consideration, what are some of the options people have when setting up a pooled investment fund, and what do you perceive to be the differences?
Yeah, so there are
disadvantages.
Yeah, there are a number of different options. I would say the primary ones right now are the Reg D offerings, either a 506B or a 506C offering. At a really high level, those are just private securities offerings. So you don't need to register the security with the SEC. It's not traded on a public exchange, but there are, a variety of rules and regulations that you need to comply with to be able to issue a private security under those regulations. The other primary options are probably Regulation CF, which is short for crowdfunding. That's somewhat similar to the 506 offerings, but you've got a broader range of investors who can invest a smaller amount. The biggest limitation on a Reg CF offering is that you can only raise $5 million. So depending on what you're trying to accomplish, that may just not work for you at all. A Reg A or Reg A Plus offering is another offering that is fairly popular these days. Reg A has actually been around for several decades, but nobody used it before because of some of the limitations involved in it. Reg A Plus was a set of amendments that changed Reg A to expand the number of investors that you can take in, the type of investors you can take in, and the amount you can raise. And Reg A itself is fairly complicated. There are two different layers. Under the primary layer that I think most beginning fund managers would start out with, you can raise up to $75 million. You can raise it from unaccredited investors as well as accredited investors. But there are a series of filings that you need to make with the SEC before you can do that. There are a series of reporting obligations that you'll have to your investors. Generally speaking, the less sophisticated your investors, so your unaccredited investors, the more reporting requirements you'll have imposed on the regulation. And Reg A Plus it was intended to kind of democratize real estate investing and other investing, and let a lot more people bring money into the kinds of offerings that our audience here is considering making. But with that expanded investor base came concerns about how to protect those investors. And so you've got additional reporting and other obligations that you don't have under the Reg D offerings. And those are really the primary offerings. People also talk about other products like a customizable fund or a REIT. Those are actually just different forms of offerings, usually under Reg D or potentially under Reg A. A REIT has some certain tax advantages to it that you don't get, and if you're just doing an ordinary non-REIT structure. But then again, there are some other, accounting and other disadvantages to that. So there are a lot of
there's trade-offs always, right? I mean, like that's what everybody asks and questions around. Hey, I heard this, or I went to a conference and I saw that, or I read this online, or a group I belong to, somebody was talking about this, and think there's a panacea. But my experience is that there's just always a trade-off for just about everything advantage you think you might have. There's some other thing that you have to then deal with that maybe you didn't anticipate. Would you?
Yeah, I'd say that's true in life generally, but it's particularly true in the securities world. When you're selling securities to private investors, there are lots of trade-offs, and identifying that balance can be tricky. Going back to the earlier question, Matt, that's where sometimes the lawyers don't recognize all of the trade-offs involved in a particular situation. They can tell you what you need to do to qualify as a Reg A Plus offering versus a Reg D offering, but they may not fully understand
why. Like, why would you do it, or what is the implication, and how does it tie to your investor base or your operations or your capital raising or whatever?
Yeah, and they'll be able to tell you, you've got additional reporting requirements under Reg A Plus, but they've never put those reports together and don't understand how tricky it can actually be to, pull together the information in a timely manner, get it out to your investors in a way that satisfies the regulations and those kinds of more nuanced issues.
Yeah, another question I get all the time, Jay, is like, can I have someone else raise the money for me? Like, can I just like, I don't really want, to deal with it, or can I have someone like, can I pay them? What is, again, the high level, non-legal advice stuff, but best understanding, like if a manager wants to have some other person actively out selling and raising money for them, can they do that? Can they not?
Yeah. And that's it's another very nuanced area where there are lots of layers, but at the highest of levels, I think the main thing you need to be concerned about if you're thinking of hiring somebody else to raise capital for you is that if you're paying them based on the amount of money that they raise, which is typically how people want to get paid, they are almost certainly engaged in broker dealer activities and need to be licensed as a broker dealer to do that. That said, there are lots of people out there who don't fully understand that or don't care and may offer to raise money for you for in exchange for a percentage of the capital raised, but that can create problems for you and down the road, sometimes unknowingly. Did that answer your question? I think that's probably the biggest issue in that area.
Yeah, and that, look, and I've seen and heard ways to try to deal with it, right, by becoming, not tying it directly to the amount raised as a percentage, and or having other responsibilities for the management of the fund besides just raising capital. So I think that, my experience is that there are ways to appropriately structure it to where they don't necessarily have to be affiliated with or be licensed and hang a tag with a broker dealer. But again, it seems like depending on who you talk to, where you're located, which lawyer you're dealing with, what your particular situation is, all of those things can be a factor in coming up with an answer, a correct answer.
Yeah, at Fairway, we spent, we probably spent, 2 or 3 weeks worth of legal time and a bunch of money, trying to figure that out in some specific instances where we were working through some things, at Fairway. And that's the kind of effort it takes to really fully answer that question based on the specific circumstances of your situation.
Yeah. What about another question I get a lot, Jay, and I think there's a lot of confusion around this one is feeder funds, taking in foreign, investor money. And what do you know about a feeder fund? Like, would a typical manager want to consider doing that, or is it too complicated, or what's your thoughts on that?
Yeah, like a lot of things in setting up a new fund, it really depends on where the manager's capital is coming from. And if the manager has a really solid line on investor capital from foreign investors who are not already set up as U.S. taxpayer entities, then a feeder fund might make sense. But there's a significant expense involved in setting up and maintaining the feeder fund. So I think for the vast majority of managers who don't have access to significant amounts of foreign capital, a feeder fund doesn't really make sense. And a feeder fund, just to put some definition on it, is essentially an offshore entity that would invest into your fund and receive distributions from the fund and pay those distributions out to foreign investors who come into that fund. They would be receiving their distributions from an entity typically located in British Virgin Islands or the Caymans or something like that has positive tax treaties with more nations than the U.S. does, or just don't tax that kind of distribution that way. And that would enable the foreign investors to invest in your fund without being subject to what can be some very onerous reporting and paying requirements under the U.S. tax structure. There are other ways to bring in foreign money into a fund, primarily through what's called a portfolio interest exemption that allows a manager to pay interest on certain notes to foreign investors without those investors becoming obligated to file or pay U.S. taxes. And so there are some ways other than feeder funds that you can tap into foreign money. This again is another great example of an area where if you're considering it, you think you might have access to significant amounts of foreign capital. You're pretty sure they don't already have a structure set up for investing in the U.S. on a tax efficient basis. Definitely something to talk to an attorney about who has set up feeder funds before and who knows how they work.
Yeah, they're complicated. We've looked into them, and we actually have one and set one up, and it's complicated and expensive and
Yeah.
hard to get your mind around.
And I would say in hindsight, we were unable to bring in as much capital as we were anticipating through that entity,
Yeah,
primarily due to COVID and some other timing issues like that. Based on the lack of success we had, in hindsight, we would not have set up that feeder fund to do what we were trying to do. So
yeah, yeah.
it can be a tricky thing to do.
What are some of the, I know that, if you look back over the last 10 years and some of the trends in the industry, you've seen, yeah, I mean, the most dramatic changes, I've seen in my 30 plus years in this industry. I mean, starting in 2012, 13 with the Jobs Act, right? And the ability to have general solicitation and advertising. And it seemed like, crowdfunding and all of that, kind of grew out of that. And there was a seeming trend from the SEC to make, to allow more of this to happen and more of the participation in the private markets and the quote unquote democratization of, alternative investing and all that, and then, and at various points in time, I've seen other things coming out of the SEC that seem to go the other direction. But, like what, in your opinion, what are some of the trends that you think we can expect coming out of the SEC in the coming years, especially as we, get into this much more difficult environment where I think a lot of the assets for a lot of investors who invested through, crowdfunding platforms may not be doing what they had hoped that they would do, and or they took on perhaps a lot more risk and exposure, than they really understood what they were doing. So, what's your read on kind of where things are heading from here, knowing you don't have a crystal ball any more than any of the rest of us? But
Yeah, and knowing not only that I don't have a crystal ball, but that is a question that the answer to that question is very dependent on politics. And if you get a change in administration who makes changes at the SEC, it can swing pretty radically from one side to the other in terms of investor protections and things like that. I would say that generally, what I would anticipate happening would be more and more regulation on private fund managers. The SEC, seems to be talking about increased reporting obligations. Reg BI has been a big issue, which regulation best interest, or Reg BI, requires purports to impose fiduciary obligations on managers. And the SEC has been making a push to push more and more of that kind of fairly significant obligation to protect investors in private funds, like the ones we're talking about, onto managers. And my best guess would be that we can see more of that from the SEC. I think in terms of the effort to democratize investing is a cat that's kind of out of the bag. I don't see the SEC going back on letting unaccredited investors invest in private offerings like real estate funds. But I would anticipate more and more burden on being placed on managers in terms of reporting fiduciary type obligations and similar things.
what about like accreditation standards? I've heard on and off about those changing or being increased. Any insight into that?
Yeah, I actually had the pleasure of reading through the transcript of the last SEC public hearing on that.
That
And
sounds like a lot of fun.
it was riveting. It's hard to say what they're thinking. There again, even among the SEC themselves, I think there's kind of a split in terms of whether we should keep it as it is or raise it. There's a tentative plan in place to start raising it over time, tie it to CPI or some other indices, and I think we will see some incremental increases in the thresholds for what it takes to be an accredited investor over time. But I don't think they'll be significant or fast. I think it will be a slow period of ramping up the threshold for being an accredited investor.
Yeah, and what about like AML and KYC, and what are those acronyms? And like I know a lot of managers that don't necessarily pay as much attention to those, but I have seen that has become increasingly onerous on managers over the years as well.
Yeah, and I think we can expect that to continue. AML and KYC stand for anti-money laundering and know your client. These are obligations that were initially rolled out at larger banking institutions and then have been kind of seeping down into smaller and smaller banks and eventually into private fund managers. And it's an obligation essentially just to know where your money is coming from, to know that the investors are not putting money with you in order to launder the money, and to ensure that the investors who are putting the money with you aren't prohibited from making investments in the U.S. because they're on an anti-terrorist watch list or something similar to that. Right now, the extent to which AML, KYC apply to your specific offering is a little bit gray, but more and more, if you're involved with any lenders or larger institutional investors, even your bank, they're going to insist more and more that you can make representations around AML, KYC type understanding of your investor database. So that is a good example of kind of the increasing burden that I see coming down on managers over the next several years.
Yeah, there's a lot. I mean, people can tell, I mean, we've just kind of even scratched the surface here, but there's just a lot of stuff, right, to think about and deal with on the legal side. And I have witnessed plenty of managers over my, lengthy time in this business who either don't know about this stuff or choose to sort of actively ignore it and just operate, without dealing with many of these issues. What do you think is some of the biggest risks to managers on all of this stuff we're talking about in terms of like how they go about running their funds? If you just high level.
Yeah, I think the biggest risk is really exposure to liability to your investors, whether that's directly through securities laws or through regulators. I think it's in many ways there is kind of a safe harbor for the good deal, right? As long as you're making money and returning money to your investors, you're not going to run into any kind of regulatory trouble, and nobody's going to complain about it. But if things start to go south, rising interest rates, other things make it more difficult, people aren't able to return capital to their investors, then you're running into problems, and those problems will all trace back to what you said when you were selling the security, how careful you were about the disclosures that you made, whether you made promises around returns or things like that, whether you did a good enough job of ensuring that your investors were accredited or that the investment was suitable for them, that they weren't investing more of their wealth than they should into the deal. And that's true whether you're dealing with unaccredited investors under Reg A or high net worth investors under a Reg D offering. Basically, if you're making wild promises about how well your deal is going to do, and that enables you to bring money in from grandma's living in their basement, and your deal goes south, there's some significant potential liability out there. And I know that nobody feels like that's what they're doing, but you need to be really careful about how easy it will be for somebody else to characterize what you're doing as doing exactly that down the road if your deal goes south.
Yeah, well, there's a lot more on that front, but we've probably given people more of a dose than they were bargaining for already. So, and we're getting to the bottom of the hour. So, Jay, as we wrap up here, what's one thing that your book, something that you like that you could share with people that you're engaged in right now that kind of helps you learn and grow and keeps you sharp?
Yeah, I was thinking about that, and I'm going to twist your question a little bit, Matt, and just give you my favorite podcast of all time, which was an episode of Malcolm Gladwell's Revisionist History, and he explores the history of the McDonald's French fry. And for any of us who like French fries, which I think is most of us, it's absolutely worth reaching that out and listening to it. It'll change how you eat French fries every time you eat them. So
To make
that's
you any more or less?
probably smaller portion size and more of an insistence on finding good quality French fries.
Yeah, yeah. All right. Well, how do people reach out to you if anybody wants to chat with Jay Zollinger? What's the best way to get a hold of you?
Yeah, probably my email, which you can reach me at j.zollinger@fairwayamerica.com. You can reach me pretty much anywhere through Fairway or Veravest would be the easiest way to reach out to me. We have contact information on the website.
All right. Well, Jay, hey, we appreciate your being on the show. Thanks for your wisdom, and hopefully there's some nuggets in there for people to take away and be able to chat with their securities counsel about.
Yeah, thanks, Matt, and good luck to everybody out there. Hope it goes well for everyone.
All right. Thanks everybody for being here. As we wrap up, probably won't be here next week. Going to be on a road trip with my college age kids, and but I'll be back shortly. So join us here in the near future, same time, same place on LinkedIn Live, and we'll have other people in here talking about their experiences dealing with real estate asset-based funds. So thanks. We'll see you next time, and in the meantime, stay sharp.